Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, August 21st, 2023. It is 4:07 now. Markets are closed, and what I wanted to do is get a video out to you. This is really not so far after that previous post I just shot out to you. I'm starting this one. As I mentioned, I was out of town. My wife and I didn't realize it on Friday. I would have mentioned to you that this was the weekend that my son moved in. Our youngest son, we had to send him off to college. He's a freshman, so we had to go get him moved into his dorm. And we did that and came back today. And so I literally walked in the door, had a chance to look at the charts. I've been driving all day and saw that the Nasdaq 100 was at that resistance level. Now, the reason I want to do the video and explain a little more, it is still shy of the bounce target that I laid out last week, and we may still very well get there. But I'm going to tell you why I decided to book profits, and I even took a small starter short, but hardly worth mentioning, just because my gut feel is there's a decent chance this may be it for the rally. And again, that's why I do these videos. I can cover a lot more. So again, I do need to say it's sort of a cursory look at the charts as I got home, but I think I've seen enough now to share what I see, levels to watch, levels that might indicate whether we're going to get a rally to that initial target I gave you last week, which again, this video just picks up where the one I did on Friday and on the Thursday before that left off. So that was we had a downtrend line in this 372, almost 373-ish level intersecting resistance. On Friday, I said, I had gone long here, stepped in a bit early, stepped in again at 357.60, and said that I would only add, that was a starter position as well. I told you that because we were falling down, we we're under the 50s. I initially said we needed to take the 50s back, and then on Friday I told you I revised that if 357.60 was taken back, that would be the only level I'd add to. So I increased some exposure on Friday because we did. Friday looked like this. You go to 1 minute chart, or you can go to 5. This is today right here. Here are my daybreak lines. This is today. So we gapped up, and this was Friday. So there was 357.60 was clearly taken back on Friday right here a couple times at that point, and then clearly before the close there. And so that was, to me, that's where I increased the long exposure, which is now gone. Why? Well, kind of what I got out to you before in the video today, but this morning in pre-market trades are turned off here, but you can turn them on by doing, well, I'd have to click the toggle. You can see the gap up. So the fact that we triggered that add-on, if you will, the initial reason for covering shorts, and I was short all the way down into that, and then reversing along. That case was only made, I talked about this being most likely a momentum fueled overshoot. And then the fact the futures were green this morning, that was a signal that, hey, the markets didn't, that risk of, weekend risk is over. You can see what the futures are doing now. There's no guarantee that they couldn't have, done this after the open, but they didn't. So there was, just kind of share you my mindset. That's where once it's up and they recovered that level and we were still above that level, then that shows you're most likely going to get a short squeeze in the dip buyers, those that feel it's safe to come back in. All right, so why am I not holding out for this? And hey, I could get back in, but I'll let you know if anything changes. I'm in the other way. I'm reversed. Covered those shorts and started going long here last week and into today, and then I think this is it for right now. That's I'll say this, it wouldn't change flip back to short if I didn't think the odds favor we're going to go down, nor did I go aggressively, but I may continue to add to. I talked about that yesterday. If here's where I wouldn't, if we go up here, I'm not going to add any shorts because that increases the odds we may go up and hit this target. I talked about how pros tend to average up on a position, meaning going with it on a short trade. I don't mean to be confusing. I'm talking generally speaking on long trades. Pros will buy a stock or a position and add to it only if it goes their way, not against them. And it's usually the retail investors, aka dumb money, that will tend to average down because it lowers their cost basis. But again, the whole premise for taking the trade, you've been proven wrong if the trade's going against you, where pros, it's validation that their analysis was correct. So, okay, so let's talk about, shorts. Why add here? If you do, that means we've broken out above a trend line. And this is the way in technical analysis works and trading works. This is QQQ. I'll get to the NQ chart in a second. I got you, but that I got out to you earlier today. That's pretty good resistance. It's also the good resistance on NQ that, again, I fired off to you because didn't have time to put together multiple charts or a very wordy post. It's about 364.35, so it's just like on NQ. I'll get to that chart in a second. It's dual resistance levels, both price and trend line. And let me change this tool up here to a circle tool, and that's right there, right where we close. So you can see it's a pretty clean. Here, if you can't see it, I'll zoom in. 1, 2, couple there, 3, 4 reactions. There's your price resistance. There's a lot of levels to define it. Okay, so why don't I stay long and expect this to break out? And again, it could. If it does, I'm not adding shorts. I will most likely, I'll give it a little bit of room, but somewhere in here, I'll most likely cover the shorts. I got back into the small starter short position. Okay, so one thing that I didn't like on Friday, Friday was a very hectic day. Towards the end of the day, I intended to get another video out. I had not one, not two, but 3 different contractors show up. We're still putting together the house after Hurricane Ian, which has been almost a year. Problems with our roofers I won't go into, but some serious problems there, and some pretty big problems with the pool contractor we're working with. And then so after threatening legal action, they all showed up one day. So that was me scrambling Friday. And then I had forgot to mention to you guys, realized my wife reminded me after late on Friday night, I had to move my youngest son in. We are now nesters. My youngest son just started, he'll start college. We moved him up into his dorm yesterday, so we had to drive up and spend all day driving back today. So that's why I was unavailable to get any posts out to you. So I just really worked off my phone, and I gave you the out office post. That's all I could do. This again, resistance here. Oh, but this is what I want to show you. So here's what I don't like. Remember, we've had divergence. In fact, that was part of the reason for going long at support, getting a little early. We undercut the divergence, but I stuck to my trading plan. I took the positions when, here it was. This is what we were talking about on Friday, 357.60. That's where QQQ had recovered it. And so when I'm into a position, even if I'm not crazy about it, what I'll do is I'll set some stops below if wrong, and that's what I did with NQ. And of course, it never stopped out because we went up this morning and continued up today. And so here's what happened. So I'm just going to give you the bullet points, and I'm sorry if I'm all over the place. Again, just trying to catch up here. Bullet point number 1: we had divergences, but on that dip, even if it was a momentum fueled overshoot, which at this point it was a momentum fueled overshoot of 357.60, what it managed to do is negate or burn through the divergences. Let me grab my lines here. I'm stretching the indicators nice and big so you can see them. And this was a previous low where we had the divergence heading into last week, but then we undercut it. So it's not a be-all, end-all. It does not mean that the market can't do this or the market can't do this. In no way, shape, or form does it mean that. What it does mean is I don't think the market's going to do this. That's what it means. All right, so that's my take. That's how I analyze things and give it to you straight. We don't have the 60-minute divergence there. We burned through it. We were very overbought. You can see one level I have here, and I've had this on this chart forever on my RSI down below. I've had an orange line at around 2172, which is an extreme oversold reading. The typical default on a RSI is the 30 levels oversold, but and it is. QQQ sometimes hits that level, especially in an uptrend. In an uptrend, oversold levels of 30 are a gift. You want to buy them. Usually that's going to be where the pullbacks are contained. And then once in a while you get these extreme. This is about as low in pretty much since, going back, we're looking at a 60-minute chart, but going back well into 2022. The only other time it got that far lower was right here, and we pretty much hit it right there. And both of those were buy points. So again, even in a downtrend, extreme oversold is usually good for at least a big bounce. But in a downtrend, a primary downtrend, what happens is oversold readings, you get a bounce, but it's typically fleeting. And remember, because when I'm showing you all this, yeah, they were all good buys that led to a next leg up. But based on my analysis, collectively, taking the long-term charts, the weeklies, the dailies, what's happened in the FANGs, I suspect there's more downside to come. And to me, it's still a matter of, we're going to get this, or is this maybe the end of the run? And I'm slightly leaning that way. Slightly is evident by my positioning, by going back to short, but not a full hard short starter. Nothing to go crazy right now. And but something I think to add to if that does play out, and we start to see a reversal there. Right now it's just a rally into resistance and not a rejection off that resistance. NQ, this is that chart I got out to you right before the close. This is kind of been one of my go-to time frames. You can think about it this way. I often share 60-minute charts, and even in the last couple of months I've shared with you more and more 30 and 15-minute and even 5-minute charts. That was in here. This is when the market was topping, and when you're topping, you tend to, you can move down, you get this, start to see volatility expand, and that's conducive to active trading on the shorter term time frames. But once you get a major sell signal, which we did here, remember this was a minor one up here. It was the first sell signal in recent weeks, got short here, gave you some near-term targets, including the near-term target was this trend line. But I also mentioned and continue to update that if and when this trend line goes, which I suspect it ultimately would and likely would soon, that gave us a much, much more powerful longer-term sell signal. So again, this is how I work, trying to, guess, was this just in this whole thing just a correction in an ongoing uptrend that started really on mid-October, or is this the beginning of a larger leg down? And I'm still leaning that way, guys, and that's why I am my preference right now, or was today, getting home 10 minutes before the market closed. And fortunately I didn't really have any control over that. That was a long drive. Right there, the beautiful resistance 15.043. It's comparable to what I just showed you on QQQ. You had reactions from above there, reactions from above, and it's not super solid resistance. This is more significant resistance. So again, if we pop this, hey, that's going to be bullish. It'll probably bring in the next set of buyers. Remember, these were all targets and support levels on the way down, and it happens in reverse. When you go up, support, once you're below it, becomes resistance. So this is, to just put it in summary, still my max potential bounce target. And it may be hit. I'm just not in it right now. I think we may fail here, and I'll assess things. I'll tell you this, I'll be studying the charts tonight and into tomorrow, and I will give you more updates. I might even get another one out today. But that's it. So there was that little whipsaw down through that 14,855. Remember, QQQ made a slight overshoot and then a recovery of it. And so, you can view it at glass half full or glass half empty. Glass half full, meaning the bullish scenario says you took back that level and that, whatever it was, 357.60 on QQQ, the comparable level. And because of that, that whole thing there was a bear trap, AKA whipsaw or a bear trap, meaning, shorts piled in and weak-handed longs got shaken out. So that case can be made. It's just no longer the case I'm making. Let me add back that downtrend line, which I think I had it on the 60-minute charts. There's the downtrend line. Again, what I'm calling my max potential bounce target, just not one that I'm targeting. So if you are of a different mindset on where the market goes from here, and meaning you're long and you're bullish, it's certainly a target, and it still comes in with a beautiful big dual resistance. So another way to spin this too, I'm going to calculate that. I didn't even have time, and I'll see. I might just, if I have, maybe ride out the shorts, because I'm treating these as swing shorts, potential swing shorts to add back in to catch the rest of this trend. This was just a little reversal. I wanted to gain a bounce. Initially it was a bigger bounce, kind of modified it, but If I did, I could tell you right now, and this all may change. I always say the charts are dynamic, and so is my analysis. It possibly add there, but that's not as good of a resistance as it used to be. So I can just tell you this right now. Whether I hold these shorts up to this point or not, if we were to get to that maximum bounce target, again, which was the bounce, preferred bounce target from last week, if we get there, unless I see something changes me and convinces me otherwise, that's where I'll be adding, and I'll add more aggressively to what I call full short position with stops somewhat above. And if something gets me back, into long, and I do that all the time. I know it leads to a lot of confusion on the site. I see the comments, Randy, you're bullish, you're long. I tell you, I flip around, do thousands of trades a year, and if something to convince me to muck my hand, that's a term in poker. You throw away your cards, throw away these short positions and get back long, then I'll do that. As of now, like I said, nothing big, but and it wasn't a big bounce trade either, especially got in a little bit early, added down here, added this morning, but slightly profitable. But you can see here as well on the 60-minute, these divergences, technically they're burned through because this is a lower low on the RSI on this 120-minute chart and a slightly lower low, but for all intents and purposes, they're about equal lows. So the case still can be made. You just take your divergence line like that. And again, if we break out, we could run, and that could even have larger implications. I don't think it will, but if it does, I'll tell you, you don't want to fight. You can't fight that short. So if you're bullish and long, here's what you do. If you bought last week like I did, you bought here, long, and you're still long, you didn't get that post today, no problemo. I would just stay long if that's your plan. And, let's say your average cost is right there. Then you can have a stop there or slightly below to protect profits. You can ratchet the stop up. There's still a big support level here. If we jog down like this, boom, you can go there. But right now, what I'm looking for, if we do reverse tomorrow, close the day red, go down or down pretty big during the day, that is the next support level. And will I cover the shorts if we do that and reverse? I can only tell you then. Again, I have to study the charts a little bit more tonight. But this is still where I think ultimately we're going. That view hasn't changed in the last couple of weeks, down at least to here. Intermediate term, I still have again, I got to speak to time frames. Weekly, long term, way down. I think the October lows are going to get taken out ultimately, but we're talking too far ahead to unless you want to tuck away a position, then I'll be in and out multiple times, even in my what I call my longer term accounts that I tend to do more longer term swing and trend trading. Active trading account, well, that'll be in and out of probably dozens of times. But there are the levels, and that's where I think we're going. And let me show you a few more things, all right, that I spotted today. So go back to the daily chart. This is the one I was highlighting quite a bit last week. There's that undercut of 357.60, which was a big level to me, plus the trend line. There was dual support. Remember, not one. You had intersecting support. So to me, a lot of reasons, as I clearly stated and repeatedly stated last week, to be long and to cover those shorts right there, especially tech shorts, big tech, the semis I mentioned last week. Someone asked, and then I followed up in the video and covered that short, expected a bounce there. So I'll get to those in a second. But that's dual support. Doesn't get much better, especially with the little whipsaw there, because some eyes are only on 357.60 support, and they see the breakdown. They don't see the trend line, so boom, you bounce. But look where we bounced to. Okay, these are unmodified lines. I'm going to hold my little pointer finger there. So I created that line on August 15th, right? And at 365, I'm going to color it up a little bit now. It was and still is resistance. It was actually 15th. It was actually support when I created it, okay? And so support right here, once broken, its price support becomes resistance. So here's reason number one to again, as an active trader, which I am, to book profits on the longs, even though it's not far from a monster trade, rallied right into that level. In fact, what was the high of the day? 354. I'm sorry, 364.59. Yeah, that's close enough for government work. You're talking a small fraction of 1%. So that's almost a perfect hit. You can just see the little wick on the top of that candle right there. And not just that, but look at old Mr. 50 EMA that I've been talking about lately. Remember the 50-day exponential moving average? I said I would be surprised, not shocked, but surprised to see it just fall and go right through there without the buyer stepping in. They did. They stepped in day one. That's what capped the slide. It was like a floor. Day two, and they bought it and they rallied it. Day three, they tested again. 3 days of almost perfect test on the 50, but then the 50 gave way when you close clearly below it. Day two, even more. Day three, even more. And now we rally back to it. So again, this is as simple as it gets. This is technical analysis or trading 101. Support, which is clearly the 50. It's evidenced by the fact we had 3 days of almost perfect, acting as perfect support. And then when we broke it, we moved down, closed below it, traded below it for 3 days, and we rallied back to it. So there are no guarantees. Nothing says we can't punch through it, but what I can guarantee you is that is resistance. And so a rally back into resistance is a good place to book some profits, even if they're not that big on longs for those that reverse. And then, of course, toggle lines back on. So you also have price resistance and downtrend line resistance, as I got out to you in that 120-minute chart of NQ. That's the same downtrend line. So there it is. At least 3 reasons right there. Again, if we break it tomorrow, then that's bullish because you've broken 3 resistance levels: downtrend line, price, and the 50-day moving average, especially if we have a solid close back above those. All righty. Let me show you one thing that gives me a little pause on. Well, I'll give you both the bullish and bearish. So Apple, remember, way back up here, my initial and minimum target was 176.15. It was good support, a lot of eyes. I mean, again, if you use technical analysis, every trader in the world would be looking. That's a major reaction high right there, right on that level. Hit it again, rejected, and finally a breakout back test. And you can see there when we fell back to it, multiple candles right on there. So it acted as support, which it clearly was, price target support. Then you took it out, and now you back test it from below. So that is the a case to get back into an Apple short if you covered it to game the bounce, or even if you want to short it. And that would say if we get rejected, we're going lower. One thing that gives me a little pause, not to get too bullish just yet, this is Apple. This is the big dog. I don't need to tell you, the biggest component of the Nasdaq 100, biggest component of the S&P 500. And it just holds incredible psychological importance as well as mathematical importance to the market, meaning how it's weighted in the indexes. This is my 60-minute chart. So there was support about 171. Big, strong. I haven't seen positive divergence like this on Apple in a long while. Normally, I'd be diving in with both. Oh, and I actually have, full disclosure, I took some Apple on Friday, and I kept that today. That's in a swing trading, a longer-term account. However, if it gets rejected and it takes this low out here and it burns through the divergence, I'm going to let it go. I'm considering a partial hedge because this is it's pretty tempting when you see this strong of positive divergence on the 60-minute chart of Apple. But I also have enough shorts to, it's what I call an indirect hedge. I don't do direct hedges. In other words, I don't short QQQ and then go long. That's a wash. The only person making money on that trade's my broker. If I wanted a complete one-to-one hedge, I'd just close the position, right? So when I do these indirected hedges, like sometimes I'll use Treasury bonds, a position on Treasuries against the stock market, or a position in a sector like semis or something else I might think is going to bounce against the overall broader tech sector. But so that's it. And I'm not giving that one a lot of room, but yeah, that's it, the good and the bad. So it's bounced back to resistance. And the thing is, if we are in the start of a much larger drop, This is usually what it's how the market is. It can be cruel to bulls, just like it's cruel to bears in an uptrend once the market's turned after a big drop. And then you see these nice looking setups and they just don't materialize, or even worse, it breaks out, sucks in some new money, and then only to see it go down, and then these divergences get taken out. And then remember, we're also coming off a very large divergent high and a powerful sell signal. This was that uptrend line in Apple, trend line I've been talking on for literally months, waiting to get that sell signal, which finally came right before into earnings. Back test. Once we took it out, earnings, and then boom, there we are. And so, of course, I've shared with you, I still have deeper targets on different time frames, but that's where we're at. And I added that support level last week. So there it is. We bounced back to T1. Remember, oh yeah, I guess I did tell you I took it Friday. Remember, I'm sorry guys, I've been in college mode the last few days. Both my kids are up there at the same school. Anyways, and they're both moved in now, my older one as well. All right, and it's my alma mater as well, so my wife and hers, so we had a good time there this weekend. Anyways, there's T1, T2 if Apple plays out, and it could. Sometimes you see this, and it would be a great thing for me to see as Apple continues on up, gets that first target while QQQ actually goes down. I have seen that. It's not unusual to see one of those the top 5 or 6 holdings in the Nasdaq 100, 1 or 2 to be going against the herd for a day or a couple days or so. You're just not going to see it over a long period of time. All right, so that's that. Let me just show you why we're here, what everything else looks like. There's Microsoft. Let me give you the right board. See Microsoft below trend. This is why I told you I did sort of a cursory look at the charts, but I knew where we're at from where we left off Friday. And again, I wanted to get this video out to you. So Microsoft broke support, rallied. It's back testing. That's 324 roughly right there. Alphabet sitting precariously. This one, in my opinion, hasn't broken down. It needs to really take this level out about 127. Just put in a divergent high, and this chart tells me this stock's going a lot lower. And that's it. So I don't think the risk reward for trying to gain much more of a bounce on the long side is that much worth it. In other words, I don't think there's that much meat on the bone if I'm right on my bigger picture. And so that's why I'd rather get back, get out of those longs and get back short a little bit early than a little bit late and miss out. Because if we just crap out tonight, futures plummet over some headline or no headline at all, then I wouldn't want to miss an objective re-entry. So that's why I'm scaling back in short right now. Oh, and I have a trend line on different board. I'll just put it here for Alphabet. There it is. So you can come off this March low. That's right here, the candle on March 13th. I just moved that little trend line, but I just added this one here for you. Come off that March 13th low, and you have a beautiful uptrend line. In fact, it gives you a beautiful bearish rising wedge. There's your uptrend line. Plenty of reactions. 1, 2, 3, and there's actually a couple candles there each time. Right there. Here's your divergence line right there. Right, negative divergence. So when that 127 level gives way, it's also going to be a break of that wedge. Measured target's going to be the widest part of the wedge. That's going to take the stock down far. So again, that's something this breakdown looks imminent. However, we are at support, and like I like to say, or I often say, support is support until unless broken. So you can't go crazy short because you have Alphabet falling to dual support, and the bulls could step in here and run this up, and maybe this wedge, and I think it would, ultimately breaks down, but maybe it does that first, another thrust up, and you don't want to ride that out if short. So that's it. So kind of in summary, I think a break of Friday's lows in the Nasdaq 100 and the majority of these FANG stocks is going to do the trick to trigger another wave, and most likely a pretty powerful wave of selling. That's the quick end of it. There's Amazon, beautiful uptrend line, negative divergence. I mean, they're all just right there. So again, this is why I was covering last week, covering shorts, the game of bounce. And initially, I thought it might have a little more attraction, and it could, but it's not worth it to me. Again, there's just not enough meat on the bone to risk trying to squeeze out another couple percentage points on the long side when I think I'm seeing a lot of things roll over, a lot of red flags. Oh, I'm going to get to one in here in a second for you. Treasury bonds, can't forget about that. And that was one of the main reasons I was watching treasuries all day, checking in on my phone. Nvidia, boom, big up some Nvidia. So I looked at semis again. Somebody asked, I think it was on Thursday, and then I reiterated on Friday to everyone. I answered the question. I covered my semis, expected them to bounce. I mean, how can you think QQQ is going to bounce and not the semis? And semis tend to bounce harder. So you would have sidestepped, in the last couple of days, the semis were up, almost 5%. Big resistance here. They did take out this trend line. So again, not a hard re-entry yet. If you can get this, a pop up to that 507.23, that would be a great point if you're gaming the semis long. And again, semis just had a confluence of support. They hit, again, another reason to cover last week. Primary uptrend line. That's a big uptrend line off the October lows. Plenty of reactions on it. Had a slight overshoot one day, but then closed back on it. You can see the green candle here. That was Friday's candle. Nice price support as well. This is a big level. So again, this is time to cover. If you're an active trader, I speak to all different types. If you didn't cover and you're, oh shoot, man, I just gave back 5%. I think you'll get to where we're going, deeper targets. But you could have a little more upside first. I mean, anything's possible, but that'd be nice resistance if we get there. Other than that, if I had to, give you odds, I think the odds are pretty good that this is just a whipsaw false breakout to the upside. Bulls seeing that downtrend line, and then you can see down here positive divergence right there, at least on the PPO. But I guess you could give you a divergence line like that on the RSI. It's just not great. There's that downtrend line. So I'll tell you, this would be a big old vicious mean bull trap. That's today's breakout there, and the bounce off that if we reverse. Again, you have just a confluence of support just below. So again, Friday's low. Break of Friday's lows, in my opinion, should be lights out. And I'm talking a quick move down. It's one thing to be, this is a support level. My guess is if we break Friday's lows and the semis right here and in the market, it's going to be a relatively swift drop. And in the semis, before they even blink, they're probably going to drop 5.5%. Once they take out under Friday's lows right there. Now, again, we bounce first. Maybe we bounce for weeks. That's still going to be a big level if it happens 3 months from now. So that's a level to watch. Maybe set a price alert. I'll do that now if I don't already have one. And all right, so let's talk yields. So a couple months ago, I started harping on again because, as I've said this many times, I've been reading more and more and listening to, folks in the financial, media, all the so-called experts, and the vast consensus was Fed's done, rates are done, even on the long end, buy Treasury bonds because rates are going to fall. We've seen the end of inflation, all that, all the Fed and the big brokerage firms, the big research firms all pulling their call for recession, abandoning that call. It went from hard landing to soft landing debate now to pretty much no landing and everything's good and fine. So I told you I'm on the other side of that. And again, I view that as a contrary indicator. Now, okay, so why? This is another problem today. The markets rallied because of all the reasons I just said today and on Friday, falling to support, some things with divergences, and very oversold, et cetera, et cetera, et cetera. This is no bueno. Had I seen Treasury yields down sharply today, this is the 10-year. 10-year was up, 30-year was up. It's a pretty big move. Now we are, technically, we're right at, we closed right at that previous multi-year high right there. Remember, this is the 10-year. This is my busy board, but you can see it right here. This, I don't care how many times I've heard explanations shrugging off the fact it doesn't, it's time, it's different. This increase in rates, the economy cannot absorb. And in my opinion, the odds for recession are very high in the coming, the exact timing of when it's going to be announced. It doesn't matter because NBER is going to always announce that in hindsight anyways. But this is unsustainable. And unless rates were to have a pretty good move down in the coming months, I think a recession is unavoidable. It's my opinion. I'm talking fundamentally. Now, we're not going to you trade off that however you want. All I can tell you today is this tick up in rates is unabating, and we're pushing on breaking out to multi-year highs. We're going back. Oh gosh, what do I have to do? Go to weekly here. Like I said, right now we're at yields not seen since right around. This is right in October. Remember the last true bear market was from October of 2007 to March of 09. We're right back to where we were when the last bear market started. The only difference is the world has gotten used to it's been a nearly 15-year period of falling and artificially low and excessively low rates that the world has gotten dependent on. They're used to that. And so when you look at historical standards, and that's what I get it, that's the case for probably some of the bulls on the equity markets, is, oh, well, we're just back to normal rates where they were back in time. But again, this is, in my opinion, going to cause a lot of pain. So it can go either way. Watch it. This is what I've been saying for weeks. Watch this. Watch rates if they keep going up. The fact, I always say one day doesn't make a trend. And look, there is a huge case to be made technically right here. Big divergence is forming. So even if we punch out to new highs anytime soon, it's still going to be a divergent high. So as far as my bearish call and shorts, I'll be driving with one foot on the gas and one on the brake, because if this breaks down and we see a big move down in rates, maybe we come into back test. That's the primary secular bear market downtrend line, but it's all the way down here. That could play out, and I'm still correct on my longer term macro call that this was a lasting bottom, the end of a 40-year secular bear market in interest rates, meaning falling rates, which was very bullish for the markets, and that I believe this is the initial leg up of a new bull market and rising interest rates that's going to last for many years, probably decades. Now, so on a big macro call like that, you can do this and still very much be right. That could be supported as a technical, easily. You can support that from a technical perspective. There's that long-term secular downtrend line I'm talking about right there, when rates peaked in the early 80s, and there it is. So this is a breakout, and this would be what I would call this would be, or has the potential to be, near-term bullish for the equity markets, but it's very much longer-term bearish if that plays out. However, if we get this leg down here, okay, I've got to wrap up soon. I've got contractors about to leave. I got to go over a few things with them. But if this happens, and this is actually, right, guys, I'm going to tell you right now what I'm leaning towards, an abatement of yields that is not bullish for the stock market, because it's coinciding with I think the markets could fall off a cliff here soon. Seasonality is there, and everything else, just all the extremes that we've reached, and more importantly, that paradigm shift that I've been talking about. That I said, watch it. If the rates didn't reverse, you can break the equity markets, and so you could see falling rates due to a flight to safety into Treasury. Institutional investors such as pension funds and hedge funds and actively managed funds selling their equities, realizing that Apple and everything else, and NVIDIA, the fundamentals and PE ratios and Shiller P ratios, long-term average, these things do, rising interest rates, they actually do matter again, that 50, 100, hundreds of years of established kind of rules, if you will, to the financial markets, they still do apply and still work. So that would be that. Okay, so here's the thing. I'll trade treasuries from time to time, just like the euro and the US dollar, but normally I will analyze them to kind of help either support or refute a bullish or bearish case I have on the equity markets. I do need to wrap up here. I think I've given you enough for now. And I'll follow up if there's anything I missed. I just wanted to say in conclusion, the fact, keep an eye on treasury yields. The fact that they rose today with the stock market rallying, to me, is a red flag. And that was a big part of my, hey, you know what? There may be more upside here in the equity market, but no, this is not worth it due to the fact that yields continue to climb today. That's a big a big thing. And usually there's kind of an offset when the market goes up that they'll sell off, yields will come down, and we didn't see that today. So, all right, let me wrap it up here, get the video out to you guys, and if I don't follow up tonight with anything else, I'll get some stuff out to you tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.